So we're still working on non-controlling interest here, and we've got Pell that bought 80% of Demers, so that means they control, but they don't own all of it. So 20% of the subsidiaries owned by a non-controlling interest in an outside party. And at the time of acquisition in 2010, we've got book value here, which would be common stock and retained earnings. And we've got equipment that was undervalued by $30,000 and building that was undervalued by $40,000, and both of those have a 10-year life. And then anything above that is attributed to goodwill with an indefinite life. Okay, and so goodwill's not been impaired, and we've got 3 years of earnings and dividend from this subsidiary. And what they want to know is, what is the non-controlling interest in the income of Demers for these years? Okay, so we've got the net income of the subsidiary, but we must remove from that the depreciation on the excess of fair value minus of the asset. So we have to take this 30,000 that was undervalued and the 40,000, that's 70,000 divided by 10. So we've got to take 7,000 away. So let's just map this out a little bit. So they give us the net income for each of the 3 years. Let's point at the right cell there. And then we take that 70,000 divided by 10. They both had the 10-year life. And so let's format that nicely there. And so the subsidiary's net income is the original one minus the amortization, which will be in the consolidating journal entries for each of those. And the non-controlling interest is 20%. So this would be the non-controlling interest share of income right there for the 3 years. And then the second piece is they want the balance sheet part. So now they want to know, what is the balance in that credit account in the equity section called non-controlling interest. And that's cumulative. So it's going to start out with, and you can of course do a T account, or you can do it a different way. But so let's start out with 2010. And so we would start out with the NCI share of the fair value at acquisition. And the acquisition price was $500,000 for 80%. So what was it for 100%? Let's solve for that. Divided by 0.8. So that would be the value of the 100%. And then they would have 20% of that. Let's get this all formatted so I don't have to keep doing it one cell at a time. Okay. So that would be their initial non-controlling interest on acquisition date. And then you would have to add their percent of net income. Okay, so in 2010, their share of net income would calculated up here already, and their share of dividends would be 20% of the dividends. And so the balance at the end of 2010 would be the sum of those. And now we could do 2011. And so 2011 beginning is the ending from 2010, and then we would add their share of the income from the next year minus their share of the dividends, 20% for the next year. And so beginning balance, which is the ending balance of the prior year, plus those two. And so then we've got the same sort of deal going on. We add in the income from 2012 and their share of dividends for 2012. Beginning plus those two things. And we have the ending for each of the 3 years. So this is the balance sheet piece. So first we calculated what the share of income was, which required us to do this amortization thing. And then, of course, the percent of dividends would just be their 20%. So that is the running total of the non-controlling interest piece, credit balance in the equity section. All right, ready for the next one.